All right. Hey, well, welcome back. It's another Financial Friday. I'm Matthew Atkins, Senior Financial Advisor with Clearbrook Investment Management, on here with my good friend and my boss, by the way, Ben Selleck, who's a CPA. Although he didn't spend much time being a CPA, really. He spent way more time in the financial industry and working as a financial advisor personally, as well as running companies like this. So great to have you on again, Ben.
Good to be here, Matt.
Yeah, so last week we left off with a little bit about the U.S. markets and talking about some of the opportunities that we see in other places. And so I think it'd be helpful to talk about both where we see those opportunities, but probably as importantly, how we invest in them. If a client or potential client thinks about emerging markets or foreign markets, it might be easy for them to get concerned about how we go about investing client money in a place like that. So maybe you could talk about that real quickly.
No, I don't travel anywhere with a suitcase full of cash looking for investment opportunities.
Well, that's comforting.
So yeah, where we see opportunities, we're seeing, we've talked in the past a little bit about how we think that the U.S. stock market's priced for perfect things to happen, and we don't necessarily want to put a lot of our money on assuming that perfect things will happen. We're seeing better opportunities internationally. Larger stocks internationally, smaller stocks internationally, emerging markets. And so some of those valuations are much better even versus historical measures or versus the United States. There's some decent valuations out there. That's how we actually practically do that. It's primarily one through low cost ETFs. If we want just broad exposure to a sector or a market. Two, we invest in mutual funds that will invest overseas, that have managers who have a track record of picking good international stocks, and they share the same sort of philosophical investment values that we do. Those are the primary two reasons: is through low-cost ETFs and through using managers through mutual funds that pick those stocks. And so, like any investing, there's a couple more complications to international investing we don't have domestically. One of them is currencies. So if we buy something in another country and the currencies change value, that can change the whole equation. And so you have to take currency fluctuations into account, which over the very long haul, on a broad basis, don't make a huge difference. In the short run, they can make a very big difference. So there's some twists and complications in that investing, but despite all that, we still see much more opportunities internationally versus the United States.
Yeah, so that's been the case for what, a couple of years at least, right?
It has, and the S&P 500 has still been the best game in town the last couple of years.
Yeah.
So valuations have just gotten more and more skewed. So in investing, you can have a pretty good idea with over a decade where the best place to invest in. You have no idea over the next year, 2 years. Anything can be the best performer. So if anyone tells you they know what's the best performer the next 1-2 years, they're just guessing, and you shouldn't believe them. So in any sort of valuation, what we do is we look and say, what are the long-term return prospects? Because those we can know, you can never know anything with certainty, but those we can have a better understanding of, and let's allocate portfolios to those, because the next 12 months is a coin flip. So why try to guess a coin flip?
Yeah, and it's something that it's so important as a financial advisory firm is, it's easy for most people to get caught up in kind of the day-to-day news. And like right now, of course, today the markets are down a little bit, and tomorrow they could be up a little bit. It seems to be driven by trade news more than anything right now. But it's really easy to kind of get caught up in that short-term analysis of what's taking place. And part of our job is to think longer term and try to position our clients for the best opportunity going forward. There's no guarantee that's going to happen, but at least we're trying to do that for them in the next 5, 10, 15, 20 years, and not just in the next 1 or 6 months or 1 to 2 years.
Right. Yeah, it would be foolish for us to try to do that. But one of the enemies of longer term investing for all of us, we're all human, is that all the noise in the meantime. You have CNBC who's trying to drive ratings or trying to get you to watch it. So there's always something sensational happening. And if we knew the price of our house every day, we'd probably go crazy, because we see it go up, we see it go down. That's just not helpful if you're a long-term investor. And so what I think that one of the best advice to do if you want to focus on what are my long-term goals is just Ignore it. There's a lot of noise out there. There's a lot of things that don't really matter. I mean, you have to fill 24 hours of cable news with something, and so it's not worth your time. So my recommendation is tune a lot of that out.
Yeah, and there's also a lot of fear mongers out there. I mean,
Right.
there are some, companies, Stansberg report, and some of these companies, that literally, I think they just play on the fears of people that something, terrible is going to happen to their investment dollars, or the government's going to do something crazy. And it's really unfortunate, especially for older people.
Yeah, it's fear and greed are two big drivers of investments, and I think we all have to kind of work hard to discipline ourselves to not fall into either one of those camps. And honestly, that's one of the benefits of working with an advisor, is having someone with a different viewpoint, someone that's maybe not someone that can kind of help steady you on both those ends when you're feeling a little greedy or feeling a little fearful. Having a different perspective, it's I think a big benefit to kind of helping the emotional journey of long-term successful investing.
Yeah. One of the challenges for a lot of people as they get older and they become more conservative in their investments is where do you invest then? They seem to want some exposure to the stock market, but I've heard it over and over again from the clients I work with that when you start to drill down, they're way more afraid of loss than they are hoping for gain, but they really still kind of want gains. And it's
Right.
not an easy environment right now if you have very small stock exposure because you're concerned about it to make
Right.
much money. I mean, it's been okay in the bond market, but kind of going forward, especially if we see interest rates rising, possibly, where do we go? How do we help them do that?
I think the most important thing in this investment advice, this investment environment, any investment environment, is do the hard work of figuring out what is this money for. So if you just have money and it's hard, and you don't know what it's for, it's hard to kind of make investment decisions. And so you can do the hard work of saying, okay, this is money I need to use in 3 years. And then what you invest in becomes much more obvious. This is money that, you never know, but this is money I think I'll need in 17 years. Well, that's a different investment decision. And so if you yourself or with an advisor do the hard work of figuring out what are my future cash flow needs, let's figure out what this money is for, and that drives the investment decision. I mean, there's market considerations. Should we be in international stocks, domestic, whatever? But the biggest driver of all that is what's the purpose of the money? And then it's a lot easier to figure out. If it's money you need in 2 years, there's no way I would put any of that in the stock market. I would stick in my bank account or a 2-year CD or 2-year fixed annuity or something like that, because the stock market, like I said, is to flip a coin any 1 or 2 years. And so really do the hard work of figuring out what is this money for and let that drive the investment decisions.
Yeah, that's great. And if you're living off some of that retirement funds that you saved up and you are especially withdrawing from it every month, way better to just put that money in a money market account or in your bank account and be able to draw off it. You'll sleep better at night, not worrying about it being at risk. And you'll also, have immediate access to it in case of emergency. And it just makes way more sense to not be so focused on getting a gain as you are about providing for yourself on a monthly basis and protecting the money you're going to need in the short term.
Right. That money is protected money, not grow it money.
Yeah.
And and that's part of our planning process when we work through a financial plan with someone, a distribution plan is, gosh, let's make sure we have the next few years of income that you need somewhere safe, somewhere guaranteed. And then let's give you a peace of mind there. So I think that's big.
Yeah, good. So I'll throw you one last curveball that I didn't bring out last week, kind of Ben's prognostications here. U.S. presidential race. You have a winner?
I'm not even quite sure who's running at this point. But
yeah. Well, there's about 20 Democrats. We know that.
I think it all depends on who's running against Trump. If it's whether you're going to see some never Trumpers default to vote for someone else, probably depends on who that candidate is. So at this point, it's a wide open, who knows? The nice thing I know is that I think presidents are overrated when it comes to the stock market. So you can have some immediate knee-jerk reactions. Ultimately, the president has very little to do with corporate earnings, unless there's some huge, crazy taxes up to 70% or something. But for the most part, it doesn't affect our investments as much. But I have no clue. Talking
They
about the
sure like
president.
to take credit for it, though.
Oh yeah. Oh, they love taking credit for it or not taking credit for it, but ultimately it's the president has very little to do with the actual stock market returns. But they'll take credit if it's going up.
Yeah, that's right. You can be guaranteed that in 2021, when the new president is inaugurated, whoever it happens to be, that if the markets are going up, they're not going to credit any of the past economic history, and they're going to take all the credit for themselves.
I think that's the history of the United States. I don't think that's ever happened. So I think you're
Yeah.
good bet on that, Matt.
Yeah. Good. Hey, thanks, Ben. We'll look forward to talking to you again soon. And thanks for tuning in, everybody. Join us next week as well. And I hope you have a great weekend.